You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast, coming to you from Montecito, California. And I am so excited to have today's show. It's, we're doing another Ask Buck, which, we are in a marathon of Ask Buck shows. And actually, this is not even going to be the last one. But I asked a couple of my fellow Wealth Formula Network community members to join me, and they did. So it'll be a lot more fun today. As you listen to this show, I do want to, again, consider if you like this kind of thing, if you like sort of the ability to have others to run questions by, etc., you want to be part of a mastermind, do definitely check out Wealth Formula Network. Of course, Wealth Formula Network started as a course. It was basically your roadmap to real wealth, and you can check that out at wealthformularoadmap.com. The course is good. I mean, it's got Ken McElroy and Tom Wheelwright and all these really smart people to give you a foundation. But what's happened with Wealth Formula Network is that it's really taken on a life of its own, and that community is a very, very good place to, I think, raise your financial IQ in a big hurry. So check it out. Go to wealthformularoadmap.com, and just know that today's show is kind of the way every other week is on our conference calls. We basically go through a lot of topics. We have these guys who, learn along the way, and they contribute. They're answering questions that I don't know the answer to myself. So it's a lot of fun. And we're going to get to it, this show, right after these messages. Welcome back to the show, everyone. Today, we are going to do something a little bit different. We have another Ask Buck episode, obviously. We still have a ton of questions, so this is not even going to be our last one. But in order to spice it up a little bit, I had invited everybody, anybody who wanted to, within our Wealth Formula Network group, which is like 90 people. But if they wanted to be on the show and help answer some of these questions, and of course, 2 people showed up here. So there's a very popular, there was a popular choice, I'm sure. Anyway, I do appreciate Jerry and Jerry Gosnell and Matt Stenese. Matt, did I see your name right? Your last name?
Yeah, that's pretty good. Yeah, I'll take it.
Yeah, these guys are part of Wealth Formula Network, which is our, really our online, community. We do these biweekly Zoom phone calls, conference calls, whatever you want to call them. They're not calls because they're video, right? I don't even know what you call this anymore. But they're like sort of mastermind sessions and stuff. And we just had one yesterday. It was a really good one, by the way. I thought it was very, very intense. And I'm going to actually rehash something that we talked about yesterday for clarity. Real quick before we begin as well. But anyway, wanted to get these guys on here to kind of participate because I get lonely sometimes. And, having a Jerry's been on the show before as well. And Matt, they're going to, help us out with some of these questions. And we might have another person join us as well. She was going to join, but not on yet. But hey, we're going to keep it real here. So, all right. So, guys, first of all, real quick, Jerry, tell us a little bit about yourself real quick, just so we know who you are.
Sure, Buck. Jerry Gosnell. I'm from outside of Valley Forge, Pennsylvania. I've been with the Wealth Formula Network a few years now, and I'm very appreciative to be a part of it because I'm learning a lot still each day. And so that's me.
Sounds good. And then Matt, you represent the physician world, right?
Yeah, I'm a urologist. Recently left my my practice here in Southern New Hampshire. Been with the Wealth Formula Group for about 6 to 8 months, I think, and really enjoyed the education and the knowledge that I've acquired with the group. And thanks for having me on the show.
Yeah, and one thing I would just say, I tell people all the time when they're thinking about joining Wealth Formula Network, it does end up being like kind of a little bit of it's a real community. It's turned into a real community. I mean, you're in New Hampshire and you're in Pennsylvania and I'm in California, but it's, you kind of, I don't know, it's kind of cool. It's kind of cool that way. And we have these big conversations. But anyway, before we get started with the questions, I want to, one thing that came up yesterday, and Matt, I know you were very curious about this too. We had this question yesterday about if one spouse is a real estate professional and, the other spouse is a W-2 wage earner, right? This was, we've called this many times the holy grail, being able to take those passive losses against active income. And in many regards, it is. And for most people, go for it. I mean, it's if you can do it. There was one thing that was brought up yesterday that was an important clarification, and that is that if that spouse is a W-2 employee, it was the case previously that that limitation on the deduction for W-2 income was $500,000, right? Now, for most people, that's still a pretty good deal, right? I mean, how many people out there have a $500,000 spouse and then they're a real estate professional themselves? So it didn't really matter, but there was this, we do have plenty of people in the group who are rocking and rolling way above that level. So it became a question. And I said at one point, I think I recall something recently in the tax law that eliminated that limitation. And indeed, it turns out, and you can check with your CPA, but I checked with mine, and you know who mine is. And he said, indeed, that limitation does not apply to 2020 because of the CARES Act, which is the irony of it is there's at least one of our colleagues in the group is going to benefit tremendously from COVID, right? So anyway, so that's a clarification on that. Hopefully, do you guys have any other questions on that? Any follow up on that or no?
I think the thing that was interesting to me on that was I didn't understand how it was that your involvement in your own real estate activities, when combined with the potential depreciation from the limited partnerships, made it more difficult. So if you had multiple limited partnerships, the fact that you had to aggregate those limited partnerships and the depreciation with the other activities made it a little bit tricky to use the depreciation in just kind of a straightforward way. And that was, I guess, something I learned last night, which was
yeah. I mean, it can be done. It's just, listen, when you get into these big numbers and stuff, you just have to be careful. And that's where a group like ours is really, really helpful, I think. Anyway, I'm going to move on from that because we dove so deep in that. And at one point I was like, there's no way, like 90% of the CPAs out there would not have a clue what we were talking about at that point. But it was, it's a sophisticated crew. So I'm going to start with a question from Yaron Miller. It's actually a second part of a two-part question that he had, but they're kind of different. So I thought this one would be useful. And I know we've kind of talked about this in our group. But he says he has a question, and as it relates to equity held in properties I own. He says, I have a fair amount of equity in my primary property, which I assume he means his home. Does it make sense to do a cash out refi and use that money to invest in some of the deal flow you offer, or is it better to pay off my property sooner? I was thinking that from an asset protection standpoint, having as little equity in my property would be better. Thoughts? Okay, so I'm going to start off with this one. So Yaron, first and foremost, I love the fact that you just pointed out a fact that debt on your property is the single best thing that you can do for asset protection. So that is a very that's something that not everybody is thinking about, and it is a very valuable thing. So listen, there are two ways to really, I think about this, in my opinion. One is the math, and then there's the other, which involves a lot of psychology. The math, if you just think about the math, well, it absolutely says cash out, do your refi, lever to the hilt and invest as you should, invest all that money, because you should be able to get better returns on your money than the interest that you're actually paying on that mortgage, right? But of course, there's the psychological element, and a lot of us have this, and I get it, which is that you don't want to feel like your house is, not paid for. We've been sort of programmed in many ways, you know, to think that debt is bad and that, the house that you live in, at least you want to have security in that, right? You don't want to lose it because you can't make your payments. What's tricky is that it's actually a little bit more complicated than that, right? We've talked about it in this again in Wealth Formula Network, and we've talked about it some other options which kind of represent a happy medium, which I like, which I'm going to present to you because I think it's interesting. That is, first, maximizing your debt on your personal home, right? And why would you want to do that? Again, because you don't want it to be a big target for debt collectors or your bank if you get in trouble, because you're more likely to get foreclosed on if you have equity in your house. So levering up, but then actually keeping a level of liquidity somewhere that would essentially function the same way as paying down your principal. So, listen, that principal that you are paying down is essentially dead money, right? And it's money that's really not in your control, right? Once you give it to the bank, they don't have to give it back to you. So for example, here's an example. You may be leveraged again completely and as maximally as you can be on your personal residence, but you could simultaneously take equity that you would be putting in as principal, and you could be putting it into a Wealth Formula banking account that's growing at 5.5% compounding. Okay, that's just one thought. The idea is to keep it liquid, obviously, but that's one of my favorite ways to keep things liquid. And then in that case, the arbitrage alone would put you ahead. And then you also have cash you could use if you want to do for any other purpose. And then the money in the Wealth Formula banking policy is also, here's another benefit of it, is that it's completely creditor protected and you can access it at any time. So remember, the only time you can't go and get the equity out of your house through a HELOC is if you really, really need it badly. And that's what we saw back in 2009, where, home equity line, credits, et cetera, were frozen. If you've got bad credit, all of a sudden, doesn't matter if you got bad, your home equity line of credit, it's pretty much you're not going to be able to take money out. So if you're in trouble, that is exactly when the bank is going to say, no, thank you. You're on your own. And hey, by the way, it looks like you got some equity in that house and we might want that too. So keeping a level of liquidity that represents principal in your house, but dislocating it actually from your house is a concept that we've talked about in this group, which I think is an interesting concept. Guys, do you have anything to add to Yaron's question?
Yeah, maybe this is Jerry. I'll take a stab at this as well. So you don't learn this in school that we're teaching you now, and it's all legal. It's just it's never brought to the attention. So do yourself a favor for Christmas, maybe buy into the Wealth Formula network, and you're going to learn a lot. But what I was going to say is I've leveraged most of my assets, including my primary home and some secondary homes that I have. And I've actually done exactly what Buck said. I put it in Wealth Formula banking. I put it in the other investments that are growing. I started doing that a few years ago, and now I'm just starting to see the return on that, which at first you don't see it, but you should not let any debt equity sit there. It should be invested and put into something else, and it'll pay off in dividends at the end. So that's my comments there. Matt, do you have any comments?
Yeah, I agree with everything that you both said. I think to your point about the educational piece and not getting this, I think the idea of paying off your mortgage quickly and being debt free is something that applies to people that maybe don't have financial education. And as you get more financial education, you realize that the idea of wealth building, there's a game that you never learned the rules to, that you never knew existed. And when you start realizing that this is occurring, you can start being a lot more intelligent. And I went through that transition myself. A couple of years ago, I was like, pay down my mortgage. Once I don't have a mortgage payment, it's going to add an extra few $1,000s into my monthly cash flow, and then I can use that to invest. And it's completely the wrong way to think about it. And I think the aha moment I had was, when you realize that equity is illiquid, it doesn't have any real rate of return, and it's at risk either because of a downturn in the market and loss of value due to just the market being poor, or because of the potential asset protection things that Buck already spoke to, that you really want to move as much of it out of it as you can. And I think with the caveat that you have to be educated, and you have to feel confident in the ability to take that money and invest it someplace else where you're going to earn a better rate of return. Then leverage to the extent that you can cover the debt service, and most important, then leverage to the extent that you kind of feel comfortable with your own internal barometer of how much debt you're willing to take on in that endeavor. And that's kind of what I came up with, and it's exactly what I did. I did a cash out refinance of my home last year. I took all that money, put a chunk of it into the Wealth Formula Banking, and put another chunk of it into some of the other offerings that we have through the investment.
Yeah, I mean, I think the moral of the story is, listen, at the end of the day, everybody makes their own decisions. So we're not making any, financial, this is not financial advice, and everybody needs, but the point of what we're trying to do is, listen, these questions are awfully a lot more complicated than I think most financial advisors will give you answers on. I mean, there's ways to think about them. The more you know, the more creative you can be and really come to some kind of a strategy that works for you. Let's see. Is the same idea? This is still Yaron, but he says, let's apply the same idea to my business property that I own. I have the ability to refinance at lower interest rates, as well as pulling out a fairly nice amount of cash. This cash could be used for paying off some of my business debt, or deployed into an investment that could return enough to cover my monthly mortgage payment. I really don't know what to do here. Thanks. And here again, I would say, if I'm you, I definitely get the lower interest in place, right? That's no doubt about that. However, I think we are essentially, again, saying the same thing here, is that maybe, you keep it liquid through, as I said, for me, one of my favorite ways to do this is through Wealth Formula Banking, because I think it is one of the safest things out there in terms of growth. But then if you keep it in, and if you keep that money in the business, I think even potentially bigger than the target on your house is the target on your business, because I know I think you're also a health professional as well. And so that's exactly kind of what you don't want to do. I think there's a way in general, and I think what we're getting at is that you don't have to be a complete leverage to the hilt, or pay off my house to my business person. You can do something in between. But I like the idea of separating the risk by putting that capital somewhere else that's not in the direct line of fire of everything else. So anything else to add there, guys?
I agree with
just
you 100%.
Cool.
I was gonna say, just with the historically low interest rates at this point, there's no better time to do it. And if it, 5 or 10 years down the road, it's better, then you can lower your interest rate again at that point. So
Right.
I don't think there's any downside in taking advantage of the rates as they are now, to the extent you can.
Yeah, but I would argue this. I would say something like, look at the interest rate and that delta in between what you are currently at and what now, and see if it's worthwhile. Because believe it or not, people are charging fees beyond belief to do refinances on things, right? And if you look at those numbers, sometimes it may be not advantageous to say, I'm going to do this for a lower line. I'm doing this for a combination of a lower line and getting that equity out, right? Figure out those numbers, because then you can do the application. I've learned that recently, and I think everyone should be aware of that.
Cool. We got Nate Shaw. He says, hey, Buck, you've addressed this in recent episodes, and we're all trying to figure it out, but I'm wondering what is going to happen with real estate, both multifamily and single family house, in the near future. As we've seen multifamily rent collections have held firm, and prices have not dropped at all, at least in the markets we're in, I guess. Single family houses, single family house markets across the country are spiking upwards. However, it is tough to make sense of this given the mass economic damage we have seen in the form of job losses and business closings. Stimulus ran out, but rent collections remain high as people are apparently using their savings and are close to depleting them. And now we have a new president who's stimulus friendly. So we are likely to see more bailouts, evictions, moratoriums, and other pro tenant policies enacted. All of this lays on top of a backdrop of the Fed printing massive amounts of currency and saying that the interest rates will go low for years. So, my $1 billion question is, will the economic damage caused by COVID-19 ever propagate through and cause rent collections to drop and thus multifamily prices? Will single family home prices ever stabilize or go down? Or will the Fed and government policies thread the needle to avoid most of the pain and continue to drive up asset prices higher? Thanks. Well, good questions, lots of them. And I think a lot of people are thinking about this. So I'll take a stab at it. A lot of people have talked about this in the way you have, and I can almost hear it, from some of the other podcasters out there, and myself, who was early on during COVID, really talking a lot about my concern about a tsunami of defaults. After the initial insult from COVID. In terms of single family homes, and we've seen this, we've talked, when we talked to George Newberry about this, he kind of alluded to it as well. I still think that it's likely, especially in middle class neighborhoods where it's just a matter of someone losing their job and not being able to pay their mortgage. I think it's very likely that we may see some trauma there. And according to the data that George had, I think he was just on a month or two ago, he was actually saying we were back to those levels of 2012 in terms of foreclosures and distress in the single family home market. But we also talked about how strong the markets on the coasts and especially outside of the cities were. So it's not completely one way or another, but I do think there's distress coming. Probably some distress that wouldn't be surprised about in the working class single family house space. But here's what we've seen in multifamily in high growth markets we're in. People are paying rent, right? And overall, our portfolios, which is again, $400 or $500 million of real estate, we've seen occupancies that are, they're similar to what we had in pre-COVID times. In the meantime, we've also had this incredible good fortune, at least in terms of valuation, of decreasing, falling interest rates, which no one thought was going to happen except for Dave Steele of Western Wealth Capital. It was, he didn't know about COVID, but he was predicting lower rates. And why is that important? Because that's pushing down cap rates even more than they were. And also, at the same time, there's a ton of, investor money out there that is brand new to our space, because there's people who are in, retail or office or whatever. They're looking for a new home because that stuff got torched and it's no longer, doesn't look as safe as it was. So all of a sudden there's this new money that's been added to the multifamily scenario, but they don't really know what they're doing. And they don't really have, a leg up on these opportunities like those of us who've been doing this for a while. So the assets that we bought a year or two ago, and the good news for people in our credit investor club is that I think we're going to benefit a heck of a lot from this, in terms of valuations as we look at refis and divestments in the next year or two. As far as rent collections going down, here's the thing, right? Like in the next couple of months, could it happen? Yeah, absolutely. It could happen. Sure, it could happen. But let's go back to the big picture. And the big picture is what you need to do when you invest. Why are you investing in these assets? They're not so that you can flip them in a month or two, right? Are you investing in them for rent collection over the next 6 months, or are you investing in them to make a lot of money over the course of the next several years. And I think if you're thinking about it in terms of the longer period, not just a few months. So what that means is that as long as we survive the next 6 months, which I think we have a very good chance of doing, I think that the next 5 to 7 years after that are going to be very big growth years in the U.S. economy. I think we're going to see asset prices, go up even more. Um, and frankly, that's why I am personally not worried and right now very bullish on investing now, as I have been in a very long time on these large multifamily assets and also in self storage as well. I mean, self storage was basically untouched through this space as well. Anyway, bottom line is we're going to get through the 6 months. We're going to kick butt. I mean, but anything can happen in the next 6 months. We're not investing for the next 6 months. Guys, anything to add to that? Do you have a comment on that, Matt?
Yeah, I mean, I think, and I think there's going to be segments in certain parts of real estate in certain areas of the country that are going to feel it more than others. But I think, I remember before all this happened, the end of 2018, and the constant question was, when is there going to be a recession so I can get real estate on sale? And like people seem to forget that, in the last 5 or so recessions that we've had, real estate's only been significantly affected in like 2 out of the 5 of them. So, and you got to go back and look at the fundamentals. The fundamentals were in 2008, we were overbuilt, people were over leveraged, there was a lot of bad loans. And now that's not happened. We're underbuilt. Bank lending has been relatively safe. And so I don't think you're going to have nearly as many foreclosures and such as you did before. And because you have all this money that's been sitting on the sidelines waiting for this event when real estate's going to go on sale, if it doesn't, I think the money's going to flood into these, these assets, and they're going to keep the asset prices afloat, and pumping $4 trillion into the economy isn't going to hurt either.
Yeah. The truth of the matter is, I'll tell you this much, Matt, is that the smart money, the big money out there is not looking in there thinking the multifamily market is tanking. They're not thinking that. They're not sitting on the sidelines. They are in. They're in and they're trying to buy. The only people who are sitting on the sidelines right now, honestly, are mom and pop investors. And I think it's a mistake if you are waiting for, some sort of, like I said, my zombie apocalypse scenario. I think you might be out of luck. So, anything to add there, Jerry? I know you kind of fell off there for a second.
Yeah, no, I think I agree with you guys 100%. So, I have a few single family homes, right, that I look at, and I have no problem getting renters right now. None. Matter of fact, they're applying to get into our properties before they even see the property. So that's the big change that I've seen. So there is a circle going around right now, but I totally agree with what you guys are saying.
The other thing is that traditionally when there's problems with single family foreclosures and stuff like that, that actually can help, that can help multifamily markets as well. And remember, we, for the last couple of years, we've really hyper focused on a very specific niche within multifamily, which I think has really helped our cause. We've not gone for the trophy properties. We're not looking at A-class, fancy schmancy stuff that you can show your friends. I mean, the properties we're buying are ugly, generally pretty ugly. And it's so what though? I mean, it's middle-class property, right? It's middle-class, working class people who need to rent. And as times get a little worse, or less likely to buy homes, they got to live somewhere. And so for us being able to, be in that market, and I'm not talking about like, D-class stuff. These are like hardworking people who need a place to live, like construction workers, that kind of thing. And then on top of that, we're also in these markets and like Dallas and Phoenix, Scottsdale, where there's job growth is huge. And you're going to see lots of that in the next a few years here, lots of job growth. And you see a lot of migration outside of, places like California. So I live in California. I love it, but I would never do business here. Right. And and you're going to continue to see that flight. And so overall, I think it's a little bit of a segmentation here. There might be some distress in some of these areas, but I think we're in pretty good shape. Similar question to that, Matt is Thessing has asked is, hello, Buck. I love the Ask Buck segments. Matt is actually in our group too, right? Wealth Formula Network. He has a couple questions. He says, one, and this is similar. I can't help but think the once in a lifetime effects of COVID-19 on our economy in some way, shape, or form would at some point also reveal once in a lifetime buying opportunities for opportunistic investors. What and when do you see the major opportunities on the horizon? And not just specifically real estate or subclasses in real estate, although I would like to hear your thoughts specifically on real estate as well. Well, again, we just talked about multifamily. I just don't think we're going to see it. I think that people are waiting. It's going to be a very anticlimactic time where you wait and you realize there was no implosion. In fact, you're seeing prices go up. So I think that the idea of waiting on the sidelines for something inherently to me has a risk. If you're not deploying right now, I think markets get hotter and hotter. I don't see it in what we're doing, but other kinds of real estate, sure. I mean, the issue is, are you interested in those other things? You could probably get a pretty good bargain on some strip malls and office buildings and, stuff like that. But I mean, we've seen part of why we never get into that stuff is because the volatility of, a recession. It does, these things just never seem to fare all that well. And so to me, I like boring multifamily. People have to live somewhere, and self-storage. People leave their stuff somewhere, and they keep having to pay, and it's too big of a pain in the butt for them to have to go move it if you raise their rent by $6 or $7. But guess what? By the end of the year, everybody's stuff gets raised by $6 or $7, and there's a 10 or 15% net operating increase bump just from rent. I mean, so these are boring, and not sexy, but that's what I like when it comes to investing. Do you guys have any comments on that?
No, I agree. Sorry, go ahead. I'll let you go, Jerry.
Okay, thank you. I mean, I was gonna say, I agree with you 100% on that. Again, it goes back to the education. People aren't educated about these things. They're scrambling all over the place. The stock market makes everything jazzy and stuff, but boring is actually better when it comes to this.
Yeah, for sure. Matt?
Yeah, no, my thought is, I think there's going to be some deals in commercial strip malls and what have you. Shopping malls, I think, are going to be distressed. I think certain areas, like I can't imagine commercial in New York City is going to be faring that well for a while. But again, are you interested in investing in that? No. I think outside of real estate, I do think there's probably going to be opportunities to buy businesses. Like if you've ever wanted to be a restaurateur, I think, in the next 6 months, if you can buy a restaurant that went out of business and start it up yourself, there's going to be a lot of pent up demand for people that haven't gone out to dinner for, a year. And that's where I think the opportunities are going to be is picking up businesses that have, gone under and then starting them again, just as the economy starts to tick up, as we start getting vaccinated and can start getting back to some semblance of normal.
The word on the street is never buy a restaurant.
I didn't say I was going to buy a restaurant.
That's what I hear. It's a tough business to make money. But yeah, I do think that there's probably some businesses out there. But again, like the stress test of this whole thing has, I think, also provided some insight into, what kind of businesses are more resilient than others. I mean, I do think that, my brother's a private equity guy, and he's we've talked about this a little bit about potentially looking at creating a fund of recession-proof businesses and things like that. What are those types of recession-proof things? Well, they generally correspond with like the 7 deadly sins, right?
That's right.
It's like
That's
drinking.
right. That's right.
Pretty well this year.
All those kinds of things. So at any rate, I do think, I'm sure there's bargains out there, but I think, one of the things I would suggest if you're, I think the real challenge in one of the lessons of my years of fumbling around before I feel like I've gotten really good at what I'm doing, is that if chasing shiny objects, you know, and waiting for like the deal, waiting for, some kind of, home run, uh, sometimes is a little bit dangerous, right? Especially when you're looking for in a distressed market. Okay, what else can I buy? Can I buy a business? Yeah, sure, you could buy a business. Do you know anything about running a business? I mean,
That's the difference. Yeah.
so it becomes really challenging, and I would again just try to keep it as boring as possible, and listen. We had Dave Steele on, Western Wealth Capital. Buying ugly buildings, making them look not as ugly, and they're averaging just around 30% annualized return to investors after or after 30 investments. So what's exciting, and that you could do real estate development, you're still not going to get returns like that. You could, I mean, shoot, there's just not much out there. So I would just caution against trying to look for things that are, bargain basement prices, because even if they are, you may not be the guy to buy them. So, um, he has another question. Matt says, how does your investing strategy change with a Biden presidency, with control of the Senate and without control of the Senate, depending on the outcome in Georgia? Well, I mean, all you can do is, right now, listen, the laws have not changed. We still have bonus depreciation, which is 100% bonus depreciation, which is a big part of my personal strategy. So if it's me, until there's legislation in Congress on the table, nothing, nothing is allowed to, from my understanding, and somebody correct me if I'm wrong, but not until that point can something be retroactive to that point. So say for example, February comes around, March comes around, and nobody's put any legislation on losing 100% bonus depreciation for the year, for 2021. My understanding is we can take that up until that point. Guys, you may want to comment on that, but I believe that's the case. But bottom line is, for me, I'm going to continue just investing in good assets, because I think the danger you can get yourself into is trying to time all of this. Now, what do they tell you? Let's borrow for a moment from our, traditional wealth advisor types. They just tell you, well, just keep putting money in, and over the long term, you'll be fine. And of course, that with stocks and stuff like that, it's not my space. But what I can say is that I know very high profile syndicators and real estate people who've barely bought anything in the last 5 years, because of this idea that there was going to be a big implosion of real estate and asset prices. Guess what? Western Wealth Capital is only just 6.5 years old. One of their investors went from 750 grand of principal initially, is now up to $4 million in principal. That happened during that period of time. And to sit around and wait 5-6 years, waiting for the sky to fall, I think it has its own inherent risk. So what do? My thought is you continue to deploy capital. If you continue to deploy capital over a period of time, you're going to hit some periods in time where it was, in hindsight, the best time ever to buy. And sometimes you're going to buy when, well, maybe it was not as good. But what we're trying to do here is create overall solid returns with good assets. You try to predict the future more than that, chances are not good that you're going to win that. Guys?
I mean, I agree. I mean, I think it's the idea of just constantly being involved and constantly figuring out where, once you have a chunk of money that you can deploy, where's the best place to put it. I think I just think you got to be involved and you got to be looking, and taking your money and just putting it on the sidelines for 5 years is probably not going to be a great long-term strategy. And instead of looking for home runs, just keep swinging. And, most baseball
Yeah.
games are won with a series of home runs and a series of singles and a series of doubles. And so you just got to be constantly swinging.
And along that lines, Matt, I would just add that, in the way we do real estate, which is buying, real estate that's already cash flow positive and just making it better. If you have a really good operator like the WWC guys or, Dante with Turo, it's actually like, hitting singles and doubles on a regular basis is kind of like, we're batting near 1,000, right? I mean, it's not like we're losing a property every 5 properties or something. Real estate in the hands of people who know what they're doing has a level of, shall I say, fudge factor to it.
Mhm.
But it's really with people really know what they're doing. Hitting singles and doubles on a regular basis should not be that hard. And then getting home runs, your occasional home runs, some of it's going to be luck, as well. So,
we've been doing this, Buck, right, for a long time, no matter what administration was in play. Now, my perspective is it's always been good when the government is divided, right? When you have, Republican Congress or Democrat president or something like that, because there's a check and balance there. Not one party's leading over another. And, but when we look at real estate, we always can sniff these things out because we're always looking at the boring stuff, as we're saying. And the government usually never gets in there. We just follow the rules that they lay out. And they're usually, again, as you said, never retroactive, if you will. So,
yeah. But I don't think, I think they've tried to do that. I just, it doesn't pan out though. And I don't think it's, I don't know if it's constitutional to change the law in hindsight, but
I also wonder how much of the concern that people have about what's going to happen with the taxes and all this other stuff, it doesn't necessarily affect what we're doing as real estate investors. It's almost like this kind of like dirty secret of the government is that, they're going to campaign on raising taxes. But when push comes to shove, I think everyone in a position of authority and power realizes that if they do a lot to destabilize the real estate market, they're going to destabilize the entire economy. So if you're invested in real estate, you're not only protected because real estate is a great asset class, but I think you're protected because the people that govern us know not to mess with it too much too quickly because it's going to cause problems if they do.
The irony of that, guys, is that, we're talking about this as if, okay, Biden administration comes in and because they're Democrats, they're going to, torch the place. And I think that, here's the facts, right? I mean, first of all, this guy's a moderate, right? I mean, he's a moderate. He's not Bernie Sanders, right? But if you look historically at economies, whether they're controlled by Democrats or Republicans, they're almost dead even, and in terms of GDP growth. And what you see is, if anything, there's a very small advantage for Democrats. And I'm not saying it's because of the Democrats. I'm saying it's because it doesn't matter who's president.
Right.
The other thing I will tell you is, to the extent that we talk about, Republican versus Democratic administrations affecting things, if you think about the biggest single piece of legislation for real estate investors in the last 50 years, it was in the 80s under Ronald Reagan.
Yep.
It used to be the case that, now we're talking about the real estate professional designation and all that stuff, being able to take those passive losses. Well, it used to be that, guys like Matt, they'd be doctors. And back then, Matt, doctors used to make a lot more money than they do now. So Matt would be coming with his $2 million, per year as a family practice doctor, or whatever he would be, back in the day. And all that the doctors just buy a bunch of real estate, and they wouldn't care about it, but because what was happening was that they could take passive losses against active income. And
the politicians did it too, right?
Yeah.
That's how they come in poor and they come out rich.
Right. Well, right? So that was something they could do, right? So they bought up tons and tons of real estate. And I remember actually Ken McElroy talking about, being a young property manager, and he was managing properties for these doctors who had no clue what they were doing, and he couldn't figure out why they were, buying property. Well, this is why, because they were taking all those passive losses and from these, apartment buildings, right? So, bottom line is, that was that is the conservative icon, who, by the way, I mean, I'm a big Reagan fan. My family's a big Reagan family, but that was a conservative Republican icon under which that happened. So I just don't think that you can say one administration versus another. I think you continue to do what you're doing. Some of the things that all of the stuff that Biden is that they've even suggested, like elimination of 1031s, all that, which probably is not going to happen, doesn't really even affect us as, limited partner investors and syndications. The only thing that I think could potentially expire quicker is the 100% bonus depreciation. Now, remember, bonus depreciation used to be 50% bonus depreciation. So bonus depreciation it doesn't mean it necessarily is going to be eliminated. It might just go back to like 50%, right? So I would just not worry about it. I think I think everything's going to be just fine. All right. So it's from Robert Holland. He says, are there any creative ways to get my real estate syndication investments, such as with Western Wealth Capital, out of the self-directed IRA without paying the typical tax plus penalty? Goal would be obviously to capitalize on bonus depreciation and to personal real estate portfolio, which can be reinvested together, growing the portfolio amount more quickly. Thanks. So, we've talked about this concept in our group, guys, right? I mean, Wealth Formula Network, again, we've talked about it there. There have been some interesting talks we've had. There are ways in theory that if securities, because these kinds of securities that you invest in technically have reduced value because they're not something that's easy to be liquidated. So in theory, they have lower valuations. And so, that kind of thing might work towards decreasing the value of those investments for valuation purposes. And if you're trying to do something like that, we are still working through that in our group. I mean, multiple people are talking about it. We've got some experts, trying to navigate the space, but we don't have a very clear way of doing it. We've also talked about using, and I know some of, people out there have used conservation easements in the past to mitigate some of the tax penalties. That's basically leverage giving. Now, I should point out that we are concerned about conservation easements this year, but a similar strategy is fee simple donation. And we've talked about those within Investor Club. Again, not giving you advice, but these are some of the things that people have done to help mitigate those. Guys, do you have anything to add for Robert there?
I mean, looking at it, I think there's a couple of tax issues with using specifically a self-directed IRA. I think the first question, the first tax concern is the UBIT tax that may get incurred by using an IRA versus a solo 401k. So there is a way around that, which is if you have the ability to put together a solo 401k, you can roll over what you have in your IRA into the solo 401k and avoid the UBIT tax or the tax on the leveraged portion of your gains. But my guess is that this question is more pointed out to like, how did I get my money out of a qualified plan into my own personal fund so that I don't have to, worry about this. And there's not an easy way to do it. I mean, once you put your money into those plans, you've made a contract with the government that says, we're going to partner with you to help you grow your investments. And as soon as you break that contract by pulling your money out, you're going to get hit with a 10% penalty and whatever additional tax you have on the earned income. And then that's when conservation easements or investing in oil and gas or something like that comes into play to decrease that liability, the tax liability.
Sounds good. Yeah, those are, I just tell the guys that generally speaking, when it comes to these IRA 401k questions, I usually bow out because I don't know very much about them. Another one of those, I'm going to throw at you guys because again, you guys are you guys actually have these kinds of accounts, I guess. is from Stefan Georgiev. He says, I left a company that I work for. I'm self-employed now, and I want to convert my employer-sponsored 401k to a self-directed IRA. Well, first of all, maybe just self-directed 401k would be better, solo 401k, but can I convert it into a self-directed Roth IRA? And what fees, taxes should I expect to pay for that conversion? Or should I just convert it to a standard self-directed IRA? Lastly, what's a good resource or direction you can recommend to go about this this stuff? So again, guys, you guys are the ones with the IRAs and 401k type things. So tell me what to do. Jerry.
So I have an existing 401k with my company that I work for. And I looked into actually taking the money I have in there and transfer it over to a Roth. And it can be done. You're right, you get hit with some penalties. More importantly, though, you're hit at ordinary income. So I have to pay all the taxes on that the government have forgiven me. And I think, Matt, you hit it right on. You made a contract with them in the beginning to take that money and bring it over. And so it effectively was not very good to do that. So there's a lot of things you have to jump through to do it. It's better off that we start it young, not old. Unless, Matt, I guess you said you used to be in a practice and maybe are out of it now. If you become unemployed and you have less income, your tax rate would go down. That's the time you probably want to transfer over from a traditional 401k over to a Roth, in my opinion. Go ahead, Matt, please.
Yeah, no, I think there's a couple of aspects. So the first is that not everybody can do that. So let's say you have your money in a 401k or a 403b, which is like the nonprofit version of a 401k. You may not be able to move the money at all unless you've left your employer. So in Stefan's case here, having left the employer, you now have a separation of service. And because he didn't go work for another job and is now self-employed, that gives him an opportunity to start an LLC, a professional corporation, or something along those lines. Once you have that in place, that then allows you to do a number of things. So you have choices, right? Should I open up an IRA? Well, the answer is you can do an IRA through like Fidelity or something along those lines, but your investment choices are going to be limited. If you open a self-directed IRA, now you have a little bit more freedom that you can invest in different things. However, investing in things that use leverage like real estate or syndications, you're going to get that UBIT tax again. So the best option, I think, at least for Stefan, and again, I'm not an accountant, but it would be to then use the fact that you're self-employed, create a company, start a solo 401k, which also has a Roth, which you can have a Roth component to it, exactly. And then roll over the money from the prior 401k into the solo 401k. And then at certain points when your earned income for any particular year is low, that gives you the opportunity to convert from the solo 401k into the Roth, which is considered earned income. But if you're doing it in a year where your earned income is low, that's going to mitigate your taxes. So, and that's what I did. I mean, I left my practice and I started my own professional corporation, and I just recently set up a solo 401k for myself. How much did it cost? The company I used, it was a few $1,000s. There's probably places you can go to get it done less expensively. But that was the cost. I looked in a couple of companies. It cost me $2,000 or $3,000 to set up set that up. There are some resources out there. I think if you go online and you look up solo 401k or self-directed 401k, there's resources out there, and talk to other people that have done it, and they can point you in the right direction for referrals.
Yeah, unfortunately, we don't do a lot of like the referrals in these podcasts because obviously if something goes wrong on those, we don't want you to tell us that
you told me.
You told me. So
yeah.
We always say, we're not giving you financial advice. This is almost like a little peer group. Exactly. And then the peer group is, telling you, but that's where, by the way, that's where Wealth Formula Network is very useful, because we can speak very openly and we can use names of companies, et cetera, because then we're truly just like a bunch of people just sharing information. Yep. So, but there is,
by the way, is exactly what I did. So one of the other members of Wealth Formula, who Buck, you put me in contact with, we called offline, we chatted for an hour, and I ended up just taking his advice and went with the company that he used.
Yeah. Okay. One last question, and then we'll call it a day here, guys. And this is like sort of this is a young person named Austin Connor, and he says, "Good evening, Mr. Buck." Mr. Buck, I like that. It's like, Mr. Buck. At least give me a Dr. Buck. Come on.
Yeah, Dr. Mr. Buck.
No, that's fine. Good evening, Mr. Buck. I am asking if you can recommend any way to find a mentor. I'm 19 years old and I am just trying to learn as much as I can. There are a lot of scams out there and people just want you to become an employee for them most of the time. I listen to Wealth Formula podcasts and the Rich Dad podcast and some other investing podcasts too. I also read investment books too. But I feel like I'm at the point where I need someone to help point me in the right direction to where I want to go. Thank you for the information you've provided me thus far on the podcast. So, this is it's a tough one. And I try to think about this, Austin, because the thing about it is this concept, this idea of having like this like mentor, this wise person in your life who you turn to. I don't think I really had that. It's funny. My dad is a real estate investor, but I didn't pay any attention to real estate because the way he did it, it was like, tenants, termites, all that. I hated it. Right. The phone would be ringing off so I didn't really see him in any, and outside of real estate, he's like the worst investor in the history of the world. Right. I mean, he literally, Bitcoin, he had me buying Bitcoin. And then when it went down, he was like, sell it. I'm like, what do you mean? And of course he ended up selling it. And since then it tripled. And now he's like, I should buy it, but he's good at real estate. But the point is that for me personally, and guys, I would love to hear your take on this. I think the concept of having a physical, like human being who's like this wise, older, let's say older, because I'm not that old, am I? Gentleman in your life who can, guide you along the way usually doesn't pan out. I mean, most of the time, if that happens, it's like it happens to be you're working with somebody, you have a job and, your boss is guiding you along the way. But what I will tell you is in my personal life, if you ask me who my mentors are, they're people who I follow, I followed early on, or I listened to, or I read their books, because you don't need necessarily somebody telling you exactly what you need to do, because that's just not the way life works. You need to know what the options are out there. You need to understand who you resonate with and develop your own, person based on that. So for me, I'll always say my initial, my biggest mentor of my professional life is clearly Robert Kiyosaki, right? For me, of course, I don't go back and read Kiyosaki books. But the whole point is that he kind of, his writings and his teachings really formed sort of the basis of the way I think about personal finances. He has a lot of other theories and stuff. I'm not really, you don't have to follow everything that everybody says, but I've had him on the show a couple of times. I've told him effectively he single-handedly changed my life. Now, I only met Robert, 4 or 5 times now. And I think now he would actually recognize me and know my name. But it doesn't mean that that's any less valuable. He doesn't need to know me. I know his work. I know his thoughts. And similarly, let's look at, Robert Kiyosaki's own story. Of course, he had the story of the rich dad and all that, and maybe he really had this person in his life. But if you read Robert's books, and I'm not just talking about Rich Dad, Poor Dad, he goes back over and over to Buckminster Fuller, right? Yep. This is a guy who has very clearly influenced Robert Kiyosaki's life. And he calls him his mentor. But then it's not like he was hanging out with Bucky Fuller all the time. He went to some Bucky Fuller seminars, he read his books, and that's why he calls him his mentor. So I think that the moral of the story is, I think it's almost sort of like a practice in futility to go out and try to mentorship, out of the blue. The reality is if you LinkedIn somebody, you email somebody and say, I'm 19, I need, I want, I want to be like you someday. I want to do this kind of stuff. As much as people are nice, people just generally don't have the time. And that's the sad truth about it. But the good news is we live in a society, in a world with podcasts and with the internet and all of this, where the influences in your life do not have to be limited to living, breathing human beings in your living room. Guys, what are your thoughts on this?
Yeah, I mean, I think the idea that you're going to approach someone and be like, "Can you be my mentor?" They're going to be like, "Yeah, sure." Probably isn't going to happen. Just because, yeah, everyone's busy, everyone's doing their own thing, and so I think there's different types of mentorship, right? So you have you have like the idea of a paid mentorship, and that doesn't necessarily mean it's a scam, but there are certain people out there that will be happy to have, what you bring to the table is dollars, and they will help guide you through. And there are people that do that legitimately and provide a good value if you have the finances for it. At 19 years old, you probably don't. And then there's something else that you probably have that other people don't, and that's time. So if you can make yourself available to people that you would want to mentor you and bring a certain element of value to them, and constantly kind of trying to help and figure out the mentorship relationship may grow naturally out of you giving of yourself, you giving of your time, and you trying to make yourself a valuable asset to that person. And that value that you put out into the universe will then eventually work its way back to you. And so that's probably a better way to go about it. Identify people in your community. If you're interested in real estate, maybe go to some of the real estate meetup groups, and then you'll start networking and meeting people that are doing what maybe you want to do. And then, try to come up to them, and don't be like, "Can you mentor me?" Say, you're doing this, whatever. Do you need help with your website, or can I help you with marketing, or what is it that I can do for you to help you with your business? I really want to learn from you. And if you offer to bring something to the table, you're much more likely to get a receptive response. And if that doesn't work, like Buck said, the internet is there, and you literally have all of human knowledge at your fingertips. And the internet's more than just funny cat videos, so use it to educate yourself. And you may find that need for mentorship is eclipsed by the ability to access the knowledge of millions of people across the globe that have already done what you're trying to do.
I would just point out one other thing, which is that, and I think what Matt's saying is 100% true, that it really is about what you can do for a mentor, not the other way around, right? I've said this before, and I don't know if you're in college or if you're working or whatever, but my advice to my own children after they finish college or whatever is will be, okay, now go out and get some jobs in areas that are of interest to you, because there's no better way to learn about an industry than to actually work in it. And guess what? They'll pay you. They may not pay you much, but if you look at these early jobs in your early life, not as, ways to make some money, but actually as education, it's huge. I have at least two, so there's me, and then there's at least two other guys that I know who started their first business based on like basically ripping off a business that they worked in, learned everything about the business, took it on their own, became millionaires. That's just something else to consider. Jerry, you have anything else to add to this?
No, I think I agree with you guys. Thank you.
Okay, great.
I was gonna say, the other thing that I would add to just looking at this, a 19-year-old kid who's already asking these questions means you're gonna do well, right? Like at 19 years old, these weren't even things that are on my mind. When I think about going to medical school, like I studied hard. I paid, fortunately my father paid for college. I paid for medical school. I mean, like a decade of my life was spent learning to do something before I got paid 1 cent to do it. And in fact, that decade of my life, hundreds of thousands of dollars were spent in my education. So if at 19 years old, you decide you don't want to go to medical school to try to, make a living, like you got a long time where you can put yourself into a position where you can be of value to somebody else and build up your skills, build up your knowledge set, and that mentorship will come and you'll be successful.
I got a text from someone who's with my 8-year-old right now, and it reads, she's reading a Christmas book. It depicts Santa smoking a pipe. She is very concerned that Santa needs to stop smoking so he does not get cancer.
Uh,
On that note, we should call it a day. Guys, thanks so much for being. I mean, this is 2 days in a row. You did Wealth Formula Network. We went for a good hour and a half, yesterday. You're on again today. Thanks. It's a lot more fun with you guys than doing it on my own. So do you have anything else to add before we go, guys?
Yes, thanks for having us on. It was fun, and it was a good experience. Thank you.
Fantastic. Jerry?
Yes, it was. Thank you very much as well. I enjoyed it. Good.
Fantastic. All right, guys. Take care.
Thanks.
All right, have a
Bye-bye.
good
Thank
night.
guys. See you,
Thanks.
Buck. See you,
Dr.
Matt.
Buck. Dr. Buck.
We will be right back. Welcome back to the show, everyone. Again, I want to remind you, if you like this format, you might really like to be part of Wealth Formula Network. So go to wealthformularoadmap.com, and you can sign up for the course there, and that, of course, comes along with membership to Wealth Formula Network. You can do these bi-weekly Zoom calls, lots of content constantly. If you like to geek out on financial strategies and education and, really get the real dirt on everything, it's a great place to be. Go to wealthformularoadmap.com. Other than that, hopefully you have a great holiday ahead of you, and I will see you next week with probably another episode of Ask Buck, although we may take a detour. This is Buck Joffrey with Wealth Formula Podcast, signing off.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.